UK interest rates poised for potential cut in summer amidst fading inflationary pressures. The Bank of England's outgoing Deputy Governor, Ben Broadbent, has indicated a possible reduction in UK interest rates this summer, fueling expectations of a first cut in borrowing costs as early as next month. This potential move aligns with the bank's assessment of a significant decline in inflation, driven by the subsiding impact of the COVID-19 pandemic and the Ukraine conflict. Broadbent emphasized the bank's focus on assessing the long-term domestic effects on prices before making a decision on interest rates. He noted the divergence among analysts regarding the likelihood of a rebound in inflation later in the year, a factor that could potentially influence the bank's rate-cutting plans. Some analysts, such as Capital Economics, predict that inflation will fall below the bank's 2% target in April and continue to decline to less than 1% by year-end. This forecast supports their projection of interest rate reductions from the current 5.25% to 3% next year, a more aggressive cut than the 3.75% anticipated by investors. However, other analysts believe that inflation will rebound above 3% before year-end, citing persistent high services inflation and wage increases in the financial and business sectors. This would contribute to higher overall prices. Broadbent acknowledged the range of views within the bank's Monetary Policy Committee, MPC, on this issue, attributing the uncertainty to the rarity of such events in recent history. He stressed that the MPC would continue to evaluate incoming data and adjust its forecasts accordingly. Should the economic outlook align with current projections, which suggest a need for less restrictive policy measures, a rate cut over the summer remains a possibility. Earlier this month, the MPC voted 7-2 to maintain interest rates at 5.25%, their highest level in 16 years. Broadbent was among the 7 members who opted for no change at the time. Money markets currently indicate a 57% probability of a rate reduction to 5% at the bank's June meeting, while a cut by August is largely anticipated. The bank's decision on interest rates will have significant implications for economic activity and financial stability in the UK. Lower interest rates typically stimulate borrowing and investment, potentially boosting economic growth. However, excessive rate cuts can also fuel inflation and create financial imbalances. The bank must carefully balance these competing objectives to ensure a sustainable economic recovery without compromising price stability.